Top geopolitical tensions and their influence on oil trends. Understanding the dynamic interplay between geopolitical tensions and global oil markets is crucial for modern investors. Oil is not just a commodity. It powers economies, drives industries, and sustains global trade. However, disruptions in its production, transportation, or pricing often result in volatility that can be both a risk and an opportunity for investors. In this video, we'll delve into the major geopolitical factors influencing the oil sector and provide insights on how investors can navigate these complex and ever-changing dynamics. Oil prices are influenced by supply and demand, but geopolitical events can significantly perturb this balance. Wars, sanctions, trade disputes, and natural disasters can disrupt supply chains or alter global oil reserves. These disruptions ripple across industries, economies, and stock markets, causing price hikes or drops. Understanding these connections is essential for investors seeking to anticipate trends and minimize risks. Investor sentiment also plays a role. Speculation about future oil supply, often fueled by geopolitical uncertainties, can drive prices even before any tangible effect is seen. This means that keeping a watchful eye on political developments is not just good practice but a necessity for investors in the oil market. The oil market has long been shaped by geopolitical turbulence. Events such as the Gulf War and the Arab Spring have demonstrated how political instability in oil-rich regions can send global markets into turmoil. During the Gulf War, for example, oil prices surged as investors anticipated disruptions in Middle Eastern oil exports. Similarly, the Arab Spring led to production halts in several countries, adding to the volatility. These past events provide valuable lessons for today's investors. Geopolitical risks often escalate quickly, and understanding the potential impact can make the difference between reactive losses and proactive gains. Oil production is concentrated in a handful of regions, making these areas critical to market stability. The Middle East, Russia, and the United States are major players, but their geopolitical risks vary significantly. Middle East. The Middle East produces a third of the world's oil, making it the most influential region in the market. Its strategic location includes critical choke points like the Strait of Hormuz, through which 20% of global oil passes. Tensions in this region, such as conflicts or sanctions, can dramatically disrupt supply. Russia. As one of the largest oil exporters, Russia's role is vital. Its geopolitical strategies, including involvement in Ukraine and relations with Europe, have major implications for oil markets. United States. With its advances in shale oil production, the U.S. has emerged as the largest producer of crude oil. However, domestic policies and international trade relations still shape its global role. The Middle East is a geopolitical hotspot, and its influence over oil markets is unparalleled. Disputes among nations, civil wars, and external military interventions often disrupt oil production and distribution. Take the Strait of Hormuz, for instance. This narrow waterway sees the transport of millions of barrels of oil daily. Any conflict in the region, such as the recent tensions between Iran and Saudi Arabia, can jeopardize this vital route, causing oil prices to spike globally. For investors, this means heightened sensitivity to news from the region. A single event, like an attack on an oil facility, can cause immediate ripple effects on stock prices, futures, and energy-related industries. The Russia-Ukraine war is one of the most consequential geopolitical developments in recent years. With Europe heavily reliant on Russian oil and gas, the war has exacerbated fears of a global energy crisis. Sanctions on Russian oil exports have cut supply, forcing Europe to diversify its oil imports and pushing global prices higher. For investors, this has revealed the interconnectedness of global energy markets. Diversified investment strategies that take into account regional supply chains and global dependencies are crucial in navigating this precarious energy landscape. Tensions between the U.S. and China, the world's largest economies, extend beyond trade and technology. They directly impact global energy markets. Tariffs, sanctions, and energy export controls influence oil prices and fuel geopolitical uncertainty. China, as the largest crude oil importer, and the U.S., one of the largest exporters, are key players in determining global supply-demand balance. Ongoing trade disputes and competition for energy independence continue to add volatility to oil markets. Investors must closely monitor developments in this relationship, as any policy change or conflict escalation can affect prices. The Organization of the Petroleum Exporting Countries, OPEC, and its allies, known as OPEC+, play a pivotal role in controlling the supply of oil in global markets. By coordinating production levels, OPEC+ seeks to stabilize prices. For instance, coordinated production cuts during the COVID-19 pandemic prevented prices from collapsing. However, political differences within OPEC nations or external pressure from non-member countries can lead to disagreements, creating volatility for investors. Understanding the decision-making process of OPEC+ is essential for predicting market trends and investment opportunities. Economic sanctions can be one of the sharpest geopolitical tools, especially in the energy sector. Countries like Iran and Venezuela have faced significant restrictions on their oil exports, shrinking global supply and driving up prices. Trade wars also contribute to this dynamic. For example, prolonged U.S.-China trade tensions disrupted oil demand projections, further complicating markets. For investors, this serves as a reminder to evaluate both supply-side and demand-side geopolitical risks when making decisions. Many countries maintain strategic oil reserves to stabilize markets in the wake of geopolitical events. For example, the U.S. has tapped into its reserves during times of crisis to cushion rising prices. However, using reserves is only a temporary measure and highlights the fragility of global energy security. Investors can view these moves as signals of larger market trends. A drawdown from reserves often stems from underlying political or logistical tensions that demand deeper scrutiny. New oil producers like Brazil and Guyana are rapidly expanding their role in global energy markets. As these nations grow in prominence, investors must account for how their production affects established players and reshapes market dynamics. These emerging nations also introduce regional political risks that could disrupt supply chains or production levels. Keeping an eye on these developments will be key for long-term investment strategies. The shift to renewable energy is a long-term challenge for the oil industry. Policy decisions pushing for cleaner energy have geopolitical impacts, as fossil fuel-dependent economies face increased pressure to adapt. For investors, the balance between short-term oil demand and long-term renewable energy goals creates opportunities to diversify portfolios. However, transitions can lead to unexpected market turbulence. A cautious and informed approach is critical. Countries are increasingly aiming for energy independence by boosting domestic production or investing in renewables. This trend, while reducing reliance on imports, introduces new geopolitical dimensions. For instance, the U.S.'s shale boom shifted global oil power dynamics, challenging traditional producers like OPEC nations and Russia. Investors should track how nations' energy policies influence global supply and oil pricing fluctuations. Understanding national motivations can offer insights into market movements and investment potentials. Global oil transportation is heavily reliant on specific trade routes and infrastructure, such as pipelines, shipping lanes, and refineries. Disruptions like pipeline attacks, shipping blockades, or even cyber attacks targeting energy infrastructure can drastically affect oil availability and prices. For example, a ransomware attack on a major U.S. pipeline in 2021 caused local shortages and price hikes, showcasing the oil market's vulnerability to external disruptions. Proactive investors must assess these risks and their implications for market stability. Stringent climate policies are altering the oil market's long-term trajectory. Nations are introducing policies discouraging fossil fuel consumption and encouraging cleaner alternatives. While this trend points to a gradual decline in global demand, investors may find opportunities in adaptive industries or emerging technologies that align with these policies. Balancing the immediate benefits of oil investments with the long-term prospects of renewables is essential. Geopolitical tensions often manifest as abrupt price swings. For investors, these movements offer both opportunities and challenges. Short-term volatility can allow for quick gains, but without a clear understanding of underlying factors, risks of loss remain high. Studying historical trends and their geopolitical contexts can help investors anticipate shifts and adjust their positions accordingly. Hedging through oil futures and investment in diversified energy sectors are common strategies for mitigating risks. Investors can also consider index funds focusing on the energy sector to balance exposures in fluctuating markets. Middle East instability. The 2019 drone attack on Saudi Aramco's facilities temporarily disrupted 5% of global oil supply. Prices spiked immediately, demonstrating the vulnerability of markets to political and regional tensions. Russia-Ukraine war. As sanctions throttled Russia's oil export, Europe scrambled for alternative sources, causing price volatility. This ripple effect extended to emerging markets and created investment opportunities in alternative energy sources. Sanctions on Iran. Decades-long sanctions limited Iran's oil export potential, tightening global supply and amplifying market vulnerability during crises. The future of oil markets will likely hinge on a blend of geopolitical risks and advancement in renewable technologies. As governments accelerate the energy transition, conflicts over diminishing resources might increase temporarily before stabilizing. Investors who remain informed about geopolitical developments and their implications will be best equipped to navigate these turbulent markets. Geopolitical tensions are inextricably linked to oil markets, influencing supply chains, prices, and investment opportunities. By understanding the impact of these events and leveraging tools like futures, diversification, and real-time analysis, investors can protect their portfolios while uncovering profitable opportunities. In an increasingly turbulent global landscape, informed investing remains a cornerstone of success.